My name's Jeff Driver, General Manager of Business Development and Investor Relations for Mirrabooka Investments. I have with me today Mark Freeman, the CEO and Managing Director, and Kieran Kennedy, the Portfolio Manager within the investment team responsible for Mirrabooka Investments. So Mark, we've just announced our full year result for 2022 financial year. What did you see as the sort of key aspects of the result?
Well, pleasingly, the profit was up for the year. The profit was up 4.4% to $6.7 million. This increase in profit was due primarily to an increased contribution from investment income, as many companies increased or reinstated dividends following reductions made during the COVID pandemic. The dividend was maintained at 6.5 cents per share, and we paid a special dividend of 2 cents per share as a result of realised capital gains from sales throughout the year. The MER was down to 0.46%, which is very low for a small mid-cap fund like Mirrabooka, with no performance fees.
So Kieran, the second half of the year was potentially volatile for small and mid-cap companies within the market. Mirrabooka's performance was, as it turned out, having been ahead for the first half of the financial year, ended up well behind in terms of portfolio performance. What were the key reasons behind the portfolio performance for the year?
Yes, thanks, Jeff. So in terms of market conditions, the shadow of the COVID pandemic loomed large over the market again in this period. So firstly, on the demand side, we saw the stimulus that had been put in place was creating very buoyant conditions. At the same time, on the supply side, supply chains and labour absenteeism really added to some inflationary pressure building in the economy around the world. Add to that the invasion of Ukraine by Russia, and we saw the central banks effectively caught napping in terms of interest rates being too low for the conditions we were seeing. Once that became obvious to equity markets, we saw a pretty sharp recalibration of valuations across the market. That created some pretty significant sectoral differences. Cyclicals like energy, material stocks that benefited from rising commodity prices did well. We don't really have a large exposure to that in the Mirrabooka portfolio. We're more inclined to the longer term growth companies that suit with our long-term quality investment frameworks. And those companies were sort of disproportionately impacted by that valuation recalibration. I guess the other factor that's worth bearing in mind is, we'd had very strong portfolio performance coming into this period, as you'd mentioned. That meant some of the valuations of our stocks, were at a fairly high starting point. So that also saw a bit of a reversal through the period. But importantly, our 3-year performance numbers are still very strong.
In terms of that market conditions, how did you look to manage the portfolio through that period? And Mark mentioned a little bit earlier about the significant realised gains that we generated through the year, so you might touch on that as well.
Yeah, so it was a balanced approach. We're very much long-term at our core in terms of the way we approach the market, and we continue to do that through this period. But we're also aware of the rising valuation risks in some of our positions. So we did take the opportunity to sell out of a couple of positions and reduce some others. We sold our Xero. We reduced stocks like Objective, ARB, Reece, Mainfreight, who've been really good performers for the portfolio, really just to manage a little bit of risk around that. And as you mentioned, that did generate a large $36 million capital gain through the period. In terms of redeploying those funds, it was a bit of a tale of two halves. In the first half of the year, while we were sort of struggling a little bit for valuation, we looked at good companies with sort of less buoyant long-term growth outlooks, things like Computershare, Worley, JB Hi-Fi and Pete & Co, where we saw some good relative valuation. And then into the second half of the year when valuations started to come down, we got better opportunities to add to those long-term growth companies like realestate.com, car sales and a few others.
So Mark, in terms of the outlook for the small and mid-cap sector coming into this financial year, how do you see it, particularly given the conditions we're currently facing?
Yeah, well look, as Kieran pointed out, it's been a very volatile year, and the valuation piece was the big one where we saw the very high valuations on growth stocks really come back. So, as we're heading into 30th of June, we're actually starting to see probably some closer to fairer value in some of the stocks we like, not yet cheap, even though they'd come off quite a lot. But at least that puts a better setting in terms of the stocks we look at going forward. We've got reporting season coming up, that's going to be a big test. I think some of the interest rate increases we've seen globally will be starting to play out, but it won't be really impacting companies until perhaps the next 6 months and going forward. And I guess the extent of further interest rate rises really might put some further fear into the consumer. So, but the markets have adjusted. Our market, as I said, was closer to perhaps to the fairer value. US market's come off probably 20% since its peak, but the valuations probably still seem a little bit high. But so with that, we expect more volatility, but we're sort of ready to now move on. If we see further weakness in the good quality companies that we want to own, that would start to present buying opportunities for us.
And I suppose from that perspective, Kieran, we've got a little bit of cash within Mirrabooka to take advantage of any opportunities in a market that may present better value for us.
Yes, that's right, Jeff. And I guess we do like to keep a little bit of that just to deal with the uncertainty effectively. Yep. And what we've found through the history of Mirrabooka is you can run into periods where other funds do have pressures around their flows into their products, and we have the luxury of being closed-ended, so having a little bit of cash ready for the wide range of outcomes that could eventuate seems a sensible place for the portfolio at the moment.
Okay. Mark and Kieran, thanks for your time this morning.
Okay, thanks, Jeff.
Thanks, Jeff.